did not get the handout, there's bios in all the panels. And when I say it's an A-team, it really is. So we're not going to go through all their backgrounds, except for me to tell you that we have two outstanding entrepreneurs, one being Ashish Ball, who most recently built and sold Global Payments, one being Mike Eckert. There's Mike, there he is, next to him. Former founder, CEO of the Weather Channel, more recently the CEO of Pathfire. Sig Mosley, who many of you know is one of the more seasoned super angels in our community and has been there a long time helping many companies succeed. And Alan Tatel, who's with one of the largest and oldest venture funds in the Southeast, Norrell Mosley. Both Alan and Sig have had great experiences as operating company executives in companies that have grown significantly. So they bring a lot to the table here, and I'm privileged to be on the same stage with these guys. I thought we'd start off with something very easy, and that would be, guys, which one's the winner? No, I'm just kidding. We'll let the judges decide that one. One of the things we thought we'd talk about are some of the forces in the economy going on right now. One in particular, obviously, is the credit crunch. What's going on with banks and with lending. What the impact can be on growth companies. Certainly, you can think of negatives, but there are also some positives. I might throw this one to Ashish Ball to start it off.
Great. Thanks, Mark.
Thank you.
Can everyone hear me? Well, with the credit crunch, as everyone is quite familiar, the economy has slowed quite a bit. And I happen to have experienced this firsthand when my company was acquired in December of 2006. So during 2007, I was the recipient of joining a company that was going through some belt tightening, for lack of a better word, and a lot of the internal initiatives focused on growth, 3, 4, 5 years out, were toned down quite considerably. And the big issue is that when many large institutions try to innovate, there is quite a cost that's involved. To get the people, get the meetings, go through their spending processes, and hence the opportunity. And the opportunity is great for early stage companies that are looking to refine a business model, are willing to take some form of a variable fee from that particular institution. So the large corporate entity benefits because it's able to get things done, innovate, not slow down the long-term momentum of the company. And it's an environment like this where smaller, earlier stage companies can be the beneficiary of projects. And for companies that have a clear focus, are early stage, are willing to work a type of exotic arrangement, I think the sky's the limit for early stage opportunities.
Mike, how did the Weather Channel in those days, how much of the technology or some of the R&D did you acquire through relationships, partnering with smaller companies, or even in some cases acquiring them?
May I build on his answer?
Absolutely.
Before I answer that, I really think that the answer here was right on the money for small companies, because in a credit crunch scenario, the connotation is that the company or that money is tight, and that the company involved, the parent company, the large company, is seeking new injections of capital. It's having difficulty obtaining that from the classic credit markets. So as the management deals with that issue, it can look at this from two perspectives. One is from finding more efficient ways to operate the business to reduce capital outlay. And I suspect there are numerous opportunities that entrepreneurs are thinking about every day that can be discussed and brought to larger companies to cause them to be more efficient and simply reduce their capital position. But I think also in these periods of change and flux, opportunity lies, and that more proactive thinking companies might be seeking to identify new ways to bring capital in via revenue, which from my perspective is the best way for a company to generate capital, as long as the margins are attractive enough. But technology that would enable a company to find new customers or to better service and not lose its existing customers because flux is occurring, or to better serve their customers, I think provides enormous opportunities for new technology companies. Many large companies aren't deeply thinking about those kinds of things, and I would suspect that there are great opportunities there. Now, in terms of the Weather Channel and Landmark, we generally incubated our own technology. We brought numerous people in, we learned from them, but what we did was generally learn and then do our own thing. Yeah.
Sig, Alan, any comments in this area?
Well, to me, the one that you have to look at for, you're trying to sell into the major financial institutions like the Citicorps, the BOAs, and so on. Some of my young companies have found that they are tending to slow down the process just because they are in a credit crunch and are hit with such financial times. But for the normal corporation, you may see some slowdown, but overall, I still think that you'll still see business going on, kind of like the sheep was saying.
Somebody's got to be dour about this, I guess. I'd be happy to be dour, so he was sort of heading in that direction. So if you have a curve, stop down with me. Okay, all right, exactly. Stop down with me. Okay, yeah. So if you look, Gartner's last survey, which came out in April, of CIOs, around 1,200 of them, they all forecast maybe a 3% increase globally in their IT budgets. 20% of them forecast a 10% decrease in their IT budgets. So the implications of that, and I would imagine a lot of that group is in the FI world, the implications of that for companies that we fund is it a must-have? Do companies absolutely have to have this product to go forward? It is great to look at variable-based initiatives as well, but in terms of just looking at IT investment, we're very sensitive to that one question now, even more so than ever.
Thank you. We've had 4 excellent companies present today. I had a chance to see all of them in an earlier round and to see the progress. And obviously, in any business, you've got to keep adjusting your model. But help us think about what the balance between focus on the market and then the adaptability to the changing market. What kind of advice you give the companies? Some, in cases of 6 months, may have changed their model 3 or 4 times, which makes it difficult for an investor to kind of figure out whether they are on the right track or not. Anybody?
Well, that's a tough one, particularly for a startup company. Can you hear me with this mic back there? Okay. Focus is so critical for an early stage company. I've seen so many become too wide too soon that they're not good at anything, or they're not properly rationalizing their financial model, and they get themselves in trouble. So in periods of flux and change, utilizing advisors, utilizing the board, utilizing investors who likely are the board members to help the company make decisions regarding changing from the original focus of the business, I think is critical. I think that's about all I can share on that one.
If I may add to that, I'm a firm believer in having focus and something called gates. And as I heard, the first couple of presenters, Global Crypto or ATM Direct. So in the case of Global Crypto, they want to go do a pilot. There's going to be, a series of consumers, maybe with LaSalle Bank, that are going to look to download. Well, what happens if that abandonment rate is high? What happens if that abandon rate is low? So at ATM Direct, what happens if 2 of the networks don't approve internet PIN debit? So you've got to have backups for flexibility, but when you first go in, you've got to have a very delineated focus. You need to understand your gates, and then with your board and your extended management team, you want to sit down very carefully, rigorously process, if I don't hit this gate in this time, what do we collectively do? But in general, I'd agree with everything that you stated.
No, and I would agree, but from the viewpoint of investors, I think we have to look at all of the part of our due diligence process when we decide to invest in a company. because we had to figure out how we feel about where they're trying to go, what are the gates, what are the backup plans, and hopefully, like you say, that the investors and the board members can help guide the company.
I'm just going to speak in platitudes for a minute, but the iterative, and this is a little bit to what Ashish is saying, but iterative customer feedback is so important. And there are times when you need to make a courageous pricing decision or do a 180. And I'll give you a case study of a 180 that I think is incredibly impressive. That's a company here in town that Greg Rabel founded, Factor Trust. Started off as SMS authentication for purchases, that you were actually going to have to get a SMS text message to consummate a large transaction that's on the internet. That went nowhere. But as he talked to the customers that he was trying to pitch, including banks, he realized that his technology could be repurposed, and he ended up in this business of actually providing more data in the subprime area in terms of granularity on loan payments and things because of what they had built in the SMS area. And that's because they had constantly gone to customers all the way around to hear what they were saying, and then realized, and then they just one day said, okay, we were wrong, and went in the other direction. So it can happen successfully.
To not only your market, but your advisors, but also being agile enough to recognize opportunity.
Exactly.
Let's talk about the global market we're in right now. In terms of businesses that are pursuing, whether it's pursuing something in a niche market in the City of Atlanta and other cities or others that we've talked about today, when do you think they should be thinking about the global market, whether that's as a market or as an outsourcing producer or supplier?
Well, I believe that you have to get your U.S. market at least in hand and know what you have and make sure that you know what the market is and how you're going to get to the market. Once you begin to get that growing, then at that point it would, to me, make sense to look at the international market to figure out whether or not you should be using agents and whether or not you should have your own operation. Because particularly if you try your own operation, it is very, very costly to go international. So if you aren't on sound financial grounds early, it won't work.
Yeah, I would totally agree with what Sig is saying in terms of a base model, and that being validate your product in the U.S. market, which I don't know if that's me or not, but generate the validate the product or the service in the U.S. market, because at least right now the U.S. market is the largest market in the world, and likely the opportunity to do that is in the U.S. market. Unless there are greater opportunities overseas where you can incubate something and bring it back in the U.S. market, that's very complicated and very expensive. Also, depending on the product or service, even in the model whereby one validates the U.S. and then expands internationally, depending on the particular product or service, there may be nuances, regulatory nuances, marketplace nuances that aren't identical to those in the United States. So using channel partners, consultants, I've seen businesses had them and invested in them and sat on boards of some where the customers or the strategic partners brought the business internationally and provided a lot of the momentum and market knowledge and understanding in order to help a company move more quickly internationally.
I would tend to agree, and I come from the financial services background. I could put a pretty good argument in place that doing business in different countries is almost the equivalent of having separate companies. An example I can cite is my prior company, Electronic Invoicing. The invoice in many European countries is a legal document. It has to be captured with a certificate, or all sorts of issues arise, and the way a payment is disputed is very different, and the ACH system may not function in Europe, and so forth. So to Sig's initial point, you want to get it done in the U.S., and if you think you're having a great deal of success, you might want to then expand with U.S.-based companies that have relatively large presences abroad. Otherwise, you could be getting into changing into 64-bit characters and Latin 1 and Latin 2, and it could really shift your focus away from your core.
I guess, and that's all true on the sales and marketing side. I think you guys have really hit it. On the other side, there are two things internationally that we are trying to be mindful of. I was literally walking in with Alan Koenig this morning from UPS, and I was telling him about this really cool widget company that pitched us yesterday. And I was explaining about the functionality, and Alan said, "Oh, that's great. UPS did that last year with a company in the UK. Well done, Alan." So I was completely. Again, just because technology is built here, it used to be automatically assumed that it was world class. No more. When you're talking about mobile apps and things like that, where there's much broader based adoption outside the U.S., you cannot assume, and we can't assume inherently just because we vetted it here, that it's actually going to be world class. The second thing, of course, is offshore resources and when you start to deploy them. In general, if you have that capability, where you have someone who really knows how to work with Ukrainian resources or with Indian resources, that still is long-term so compelling if you can start that early and do it in an effective way. Of course, there's been a lot of train wrecks in that area, but it's just a great skill set to have when you're starting a business.
Good point about the competition. It wasn't that long ago that we would say, well, what are they doing in California as opposed to what are they doing in China, Hong Kong, you name it. It's this much broader area you have to look at from a competitive standpoint. Let's throw an open one out there, which is more about what do you think the attributes are? What are the pros and mistakes you've seen in entrepreneurs, the good things, the bad things, that would help this audience filter a little bit more of what to look for, whether they're investors or whether they are entrepreneurs themselves?
You mean mistakes in terms of their business in general?
Probably the actions of them as leaders themselves.
So from an execution standpoint?
Mm-hmm.
I'll just start and talk a little bit what some of the judges were pressing our contestants this morning about, which I find is always an issue, is really going through the customer acquisition model. How are you going to acquire customers? What is the cost of actually acquiring the customers, and how do you get paid back? Generally, people could spend more time on that when they're presenting to us, as well as understanding that themselves when they're putting forward their plans.
And to add on to that, you've got to understand your market, and part of that is not only how to acquire the customers and what it costs, but also who the competitors are. Particularly the earlier the company, I think the poorer job that most entrepreneurs do as far as really understanding their market. They really they come in and they think they know it, but then you can ask a question. And the key is on competitors. It's not only who are competitors today, but who are your competitors tomorrow. Is Microsoft going to be looking at this? Is Google going to be looking at this? Have you really thought about the overall size of the market and things like that? And they do a bad job at that. And to me, the other execution error that I see a lot of entrepreneurs make, they don't hire quality people around them. They worry. I don't know what it is. They just don't seem to get the same caliber of person that they are to be their associates. And that says something about the entrepreneur itself. So you really need to think about who you bring in with you.
Right. I might just add, in addition to those 2 points, the decisions entrepreneurs make in the first 6 months that could ultimately come back to haunt them. People are passionate. They're scrambling. They're short on cash. They're looking to create some momentum so they could get the more appropriate valuation. And to sign up with customer XYZ, maybe you give LaSalle Bank an exclusive for a period of time, which long-term might not be a good idea to get funded. You set a pricing model based on transaction fees versus basis points, which impedes your longer-term ability to extract more value. So hopefully, during the early stages, as people are looking to build what ultimately will be a scalable business model, are they going to make certain decisions on a one-off basis that changes their focus, impacts their pricing model, or locks them out of certain markets?
Yeah, I think that what Sig said is just absolutely dead on. And I think that in the planning stage, the market understanding stage, the slice of the market that the business will deal with. Quite often, I see entrepreneurs who say our market is $238 billion. And then when you start breaking it down, it's really $1 million or $1 billion. And then understanding the current and future competitive sets is so critical. And understanding that pricing model, the pricing model against that competition, validating the product is so critical, all of which fall into marketing. Because if that is missed, then two negatives occur in the context of execution. One is that the cash model of the business will be negatively impacted because the business will be off on revenue early. And that predicates all kinds of execution and scramble issues that takes management's eye off the ball of building the business. And then secondarily, it puts management and the business in what I would call a reactive executional mode, where they're putting fires out and scrambling to save the business, rather than a proactive operating mode where they are pushing forward, building, achieving their numbers, moving forward, and continuing to grow the business. So, and therein, particularly if the management team is inexperienced or doesn't have a good advisory board or board of directors, all kinds of mistakes can be made in that reactive stage. So going back to what Sig said and really understanding what you're getting into, certainly some of the capital required for that, the market, the customers, the competitive sets, and knowing that well solves a whole lot of executional problems when the business really starts unfolding.